Let's talk more about the Fed's big month ahead and the different kinds of pressures it is facing. Joining us now is Dino Kos, Chief Regulatory Officer at CLS, and a former New York Fed official, Joe Lavorgna, Chief Economist of the Americas at Natixis, and a CNBC contributor, and, of course, our guest host, Mohamed El-Erian, Allianz Chief Economic Advisor. Lots of people at the table, lots of opinions. Dino, let's start with you. In terms of what the Fed will do, how much do you think it will be influenced by, say, what the ECB does days before that? And it's ironic because we were just talking about how globalism in trade, it's being rolled back potentially, or maybe it's at a standstill. And yet the globalism in monetary, everybody's influenced by everybody right now.
Which tells you the importance of the exchange rate, right? Mm-hmm. Because this is where the monetary policies come together. This is where they influence one another, is what's happening to the exchange rate. The fact that the dollar has been appreciating. It's a tightening of financial conditions. The Fed's going to be sensitive to it. The ECB moves, they're not going to, and you have the euro sliding, which it has been moving slowly, very, very slowly. The Fed's probably going to respond to that because, not as to target the exchange rate per se, but to try to ease financial conditions. So again, this is about, even though globalization is maybe being rolled back, still economies are connected through the exchange rate, and that's what you're seeing here.
And so should that factor into what the Fed does? When they sit around the table, should they say, hey, the ECB did X, Y, and Z?
They're not going to put it in those words, but it will be in the back of their mind, and it will be influencing them, and they'll be thinking about it for those reasons.
So, Joe, how do you think about that? And let's say Europe, let's say the EU does some sort of stimulus plan. How could that impact what we see here?
The exchange rate is the channel through which monetary policy, even with very low rates, can actually influence things, as Steve was alluding to. And I would agree. You don't want to wait to see maybe if it's not effective in case the economy slow more. And Dino was saying the Fed may not talk about it explicitly, but the exchange rate's a big issue. EMFX within the emerging markets, the dollar is extraordinarily strong. And I think the Fed should cut rates 50, if not more. They'll only go 25. But exchange rates are something that impact things. Commodities are priced, as you know, in dollars. Dollar's been strong, and that's that's causing global growth to be softer.
Why should the Fed have this weight on its shoulders?
So it shouldn't. It's interesting because I think we all will agree that the Fed's going to cut. We'll all will agree there's 1,000 points of rate cuts priced into markets around the world already.
1,000 or 100?
No. For the Fed, 100. For the world, 1,000.
Wow.
Okay. So, and we all agree that currency plays a major role in this because no one wants the currency to appreciate. Where I suspect we're going to disagree, and it's really important for markets, is separating the economic effects from the financial market effects. There's three scenarios. One is the Fed is effective in both. It boosts the economy, it boosts asset prices. That would be great. I don't think that's the case. The other extreme, is that the Fed boosts neither anymore. It's ineffective. And the middle one is that it boosts asset prices but not the economy, which is where we've been for a while. And it really matters whether you think that we're going from here to here. I think we are. And I think there's real cost in delivering on what the markets expect you to do. It doesn't mean that the Fed won't do it. It's just that we have to be much more aware of what Bernanke said. It's about benefit, costs, and risks, and we now have entered the cost and risk world.
The only problem, Mohamed, is if the Fed doesn't cut or disappoints, asset markets led by stocks will sell off meaningfully further. So they're stuck. They're stuck
and
between
the Fed will worry about
the proverbial rock and a hard place.
But it's important. They're stuck in a lose-lose situation.
Well, they're right. So you pick the lesser of the two evils.
I think one of the things that, Melissa, I would alter your question a little bit.
Okay.
We may be deglobalizing, but we are by no means deglobalized, okay? Sure. We are seriously in a world that is dramatically interconnected. And we were really just beginning to understand those connections. You ask a Fed official or anybody who runs a model, how much do they factor in global economic weakness into U.S. GDP? Nobody really knows. We had some estimations in 2018 versus 17 that maybe you cut a half a point off because global economic weakness. The other aspect of this, and I think Mohamed was talking about this in the last hour, is you may have central banks easing together. At the same time, you have finance ministries pulling apart. And the extent to which Europe and the U.S. can act together or in concert with each other to make sure we don't have a currency war, it's unclear. Remember, you have the president urging the Fed to use the interest rate as a tool to value the currency, which is the opposite of the G20 statement that was made in the middle of the crisis. We shall not use our interest rates to value our currency.
Did they say shall?
They did not say shall.
Well, you just quoted them saying shall.
I didn't
make it sound like that was
I did not do this.
Exactly. The intent
You said
was there.
okay.
It
sounded like it came from God. The way
it was
you just
a commandment. It was they all got together and said, "We ain't doing this.
Don't hype it." Okay.
We ain't doing this." And now you got the president doing this. Now, again, I've said this 100 times. The president has this way of making stuff that we don't want to talk about sort of apparent, kind of like taking the Band-Aid off the wound. It is true. As you use your interest rate, it affects your currency. So I guess I throw the question to Dino. Is it time for them? Can they all sit down and figure this out together as central banks? Will they?
You know, they have a chance every 2 months. They get together at the BIS in Basel. Lovely building. They get together at G7 meetings, G20 meetings. I mean, there's no shortage of avenues where they can. You know, but, you know, I think, you know, the truth is that ultimately there's domestic interests that matter. You know, they're going to be looking at their own exchange rates. You know, you're absolutely right about the impact that the global situation has on domestic forecasts. If you go back to look at FOMC transcripts from 20, 30 years ago, you know, the international side didn't really factor in very much. You know, hardly factor in at all. You look at them now, you know, it factors in a lot. If you look at the statements, it factors in. You look at the speeches, they factor in. So even if the world is becoming deglobalized, you know, still, it matters for policy. It matters for the exchange rate. It matters for confidence channels. It matters for investment, cross-border investment. It just does. So whether they say it or not, it matters. What the ECB will matter for what the Fed does.